Hello guys, what's going on? Welcome to What I Think. My name is Gabriel. So today I will be talking about stocks. Stock market has been going crazy for some time now, due to the Wall Street bets and all that stuff. But that's not what I'm here to say. No, one thing about investment is it's a slow process. Though some people have really made some good money from the GameStop and all other stock that really pick up at that time, but in normal investment, that's not how it works. But today, I just want to share with you how you can make some passive income, like maybe $200-300 weekly, or maybe every 2 weeks, or maybe monthly. Depends on how the whole thing works out. So first, stocks. What are stocks? Stocks, when you talk about stock trading, you're talking about owning part of a business. So let's say I want to start a business, or I've already started a business, but the business is not yet fully established, or maybe the business is fully established, but I need to expand. So that's where stock comes in. So I sell part of the business to people that are interested, and in turn they give me money to do the expansion. And when the business is fully expanded, then they start reaping the reward, either in dividends or maybe in the appreciation of the price of the stock. So that's just a basic summary. But if you want me to go in details on what stocks, the intrigues, the details concerning stocks as a whole, you can leave a comment below. But back to the business of the day. Stock option. So when we talk about stock option, this is one part that the regular retail investors have not really been exploring, and it has a lot of potentials, and it's one area that you can trade that you might not lose money. I'm careful to use the word might not use money. You might not lose money. Yeah, you might not lose money if you know how to do it right. So what are options? Options are contracts. So it's just like you tell me that, oh, I have a product to sell. This is the product and I'm interested. Then I tell you that, okay, I'm interested in this product of yours. Let's say maybe a phone or a piece of property. But you say, okay, since you're interested and you don't have money, okay, let's go on into an agreement. I'm going to put down this percentage for the property, and in XYZ time, I'll bring the full money. So that's simply what option is all about. So let's say I tell you that in 2 months' time, I'm going to bring the money for the land. That's the expiration. So let's say 2 months comes and go, you were not able to meet up, or you were able to meet up, but due to some circumstances the price of the product fell. You might not really be interested anymore. But in terms of securing the agreement, you've already deposited something, and that particular money you deposited is not refundable. I don't know if you understand what I'm saying. So since the funds is not refundable, if you secure the contract and the product appreciates, there's a contract already on ground, and that contract states that that product is for you, or the land is for you. So whenever you come, you are going to get it, as far as you come within the agreed time. So let's say the land is worth $1,000, just an illustration, and when you later came to pay for it, the land is now worth $2,000. Based on the fact that there's a contract or an agreement on ground for $1,000, the seller have no choice but to sell the land for you at that price. That's the beauty. So that's pretty much what option is all about. There are various types of option. We have the buy and the sell options. So you can either buy call or buy put. So when we say buy call means that you are anticipating that the price of the stock is going to go up at a certain time. which is the expiration time, at a certain price, which is the strike price. Then we also have the buy put. Buy put means that you're speculating that the price is going to drop at a certain time, which is still the expiration time, at a certain price, which is the strike price. Then we have the sell call, the sell put. The sell means that you already have the shares, or you have the collateral to buy the number of shares. So let's say, for example, you want to trade Apple options. What happens? For you to sell Apple options, you either need to have the equivalent of the 100 shares. And quick one, I didn't mention this before, a contract of option is 100 shares. One contract means 100 shares. So let's say if I want to sell Apple stock, which is the sell put, I need to have either the current price of Apple, which is about $130 something. So I need to have like maybe $13,000. Let me just say $130. So I need to have $13,000 as collateral to be able to sell put. So if the price of Apple drops to the strike price that I picked, then I have no choice than to buy it at that price. So let's say, for example, Apple is trading present price for 100 and let's say for 13,000, which is $130 per share, and I'm predicting it's going to drop to maybe 120, which is not going to be 12,000. So if it drops to 12,000, I need to buy it. So that means I need to have $12,000 cash in my account. But I'm anticipating that it's not going to drop to that price, so I can collect the premium, which is the difference. I'll get in details of all that in my next video. So please make sure to subscribe so that you get the full details of all that pertains to options. So, but just in summary, we have buy, we have sell. So when you want to buy, it means that you're putting certain amount on ground, which is the premium, to secure the contract. And the beautiful thing is that whatever amount the stock rises to, if you are doing a buy call, then that is yours. But if you are doing a buy put, whatever drops that the stock experience, and the money you put is going to either double, triple. You can never quantify it because you cannot determine how far the stock is going to go. So for the sell, you are pretty much you are paid before anything. You get your money before, and these are some of the things I'm going to explain in the next videos. Okay, so that is option trading. So option trading in general is a contract or an agreement which two people enter into to buy a particular product at a particular price. No matter what the changes may be, you have to buy it at that price. If it goes up, then you have to buy it, which is beneficial to you if you are doing a buy call. But if it goes down, you can choose not to buy it, which is execution of the contract. But whatever premium you paid for that particular product will not be refunded. Okay, so that is how option works. So option is pretty much a nice form, but if you're doing the buy call or the buy put, that's the risky part. So the part I'm going to be teaching you guys is going to be the sell call and the sell put. That's the part you can trade and might not lose money. On the next video, I'll give you the breakdown on how you can do that and make some quick bucks for yourself. All right, so having said that, stay blessed and have a wonderful day. Bye.